Hey everybody, Tim Albrecht here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week I had a chance to welcome back onto the show Tony Umholtz, a mortgage manager for Iberia Bank / First Horizon. During the interview, Tony and I talked through 5 steps to getting ready for a home purchase. So for those that are listening and thinking about a home purchase in the next 6 to 12 months, this episode is certainly for you. On the show, we discuss the importance of understanding interest rates and how you can find the most up-to-date rate information. We also discuss how to determine your home buying budget and the criteria used by the lender to determine your maximum loan amount. When is the best time to get pre-approved, and what is the difference between pre-approval and pre-qualification? And finally, what to look for when shopping around lenders and going through the application process. Now, before we hear from today's sponsor and then jump into the show, I recognize that many listeners may not be aware of what the team at YFP Planning does in working one-on-one with more than 240 households in 40 plus states. YFP Planning offers fee-only, high-touch financial planning that is customized for the pharmacy professional. If you're interested in learning more about how working one-on-one with a certified financial planner may help you achieve your financial goals, you can book a free discovery call at yfpplanning.com. Whether or not YFP Planning's financial planning services are a good fit for you, know that we appreciate your support of this podcast and our mission to help pharmacists achieve financial freedom. Okay, let's hear from today's sponsor, Iberia Bank / First Horizon, and then we'll jump into my interview with Tony. Does saving 20% for a down payment on a home feel like an uphill battle? It's no secret that pharmacists have a lot of competing financial priorities, including high student loan debt, meaning that saving 20% for a down payment may take years. We've been on the hunt for a solution for pharmacists that are ready to purchase a home with a lower down payment and are happy to have found that option with Iberia Bank / First Horizon. Iberia Bank / First Horizon offers a professional home loan option, aka a doctor or pharmacist home loan, that requires a 3% down payment for a single family or townhome, has no PMI, and offers a 30-year fixed rate mortgage on home loans up to $548,250. The pharmacist home loan is available in all states except Alaska and Hawaii. To check out the requirements for Iberia Bank / First Horizon's pharmacist home loan and to start the pre-approval process, visit yourfinancialpharmacist.com/home loan. Again, that's yourfinancialpharmacist.com/home loan. Tony, welcome back to the show.
Tim, thanks for having me. Always good to be here.
Excited to jump into this episode. You've been a frequent guest on the show. Last episode we had you on was episode 216, where we talked about common credit blunders to avoid when buying a home. We're going to link to that in the show notes and dig in some more detail on that topic as well during this episode. So Tony, give us the update. What are you seeing out there in the housing market? It's been a wild year, right?
It has been a crazy year. It really has been. You know, a lot of the same things we've seen before in the past. The inventory levels are still fairly tight, and rates are still low. The one thing I will mention is, and this is more of a timing thing for the time of year and the season we're in, is the autumn and the fall is typically there's a little bit less buyers out there. We have Thanksgiving and the holidays around Christmas, and typically there's less buyers, a little bit less competition. So it's often a better time to buy because there's less buyers you're competing with.
And I think that may be true for many folks in our community that perhaps were shooting for a spring or summer home purchase. Maybe they got delayed because of the inventory issue that is well known that's out there. So today we're going to be digging into 5 steps that folks can take to get ready for a home purchase. We're going to be talking through evaluating loan options, finding a lender, saving for a down payment, and running the numbers for your budget. So if you're thinking about buying a home in the next 6 to 12 months, this episode is really designed for you. And if you think home buying is in your future, whether that's now or down the road, my hope is you'll be able to pull some tips and lessons away from this episode to help you prepare for that journey. No need to take notes. You can head on over to yourfinancialpharmacist.com/home-loan. We've got an extensive resource at that site. You'll be able to check out a lot of what we've referenced today. So Tony, 5 steps to get ready for a home purchase. Number 1, know the landscape. So before even shopping around for lenders, it's helpful to have a general idea of what's going on in terms of mortgage interest rates, what the market is. So what are we generally seeing right now, Tony? And knowing these, of course, are subject to change, and where can someone go to research those rates?
Well, it's a good question here, Tim. The first step, just to kind of get a very broad view of the landscape, would be you can actually go to Freddie Mac, FreddieMac.com, and Fannie Mae. They actually post rates, but it's an average rate. So it's an average industry rate. You can also find it like in the Wall Street Journal. Clearly online, you can find it, but you would look for the weekly average rate by Fannie or Freddie Mac. Freddie Mac's quotes typically have points in them. So you do have to look at the fine print with that. It's an average rate, kind of a consensus of the industry to tell you where rates are, like a rough idea of where they are. But they're often quoted with points. So, keep that in mind, because your lender may quote you something the same or a little higher, but it does not have points. So that's just kind of a good place to start, Tim.
And Tony, I'm looking at those rates right now. So at the FreddieMac.com/PMMS, we'll link to that in the show notes. So it's showing a 30-year 3.14%, 15-year 2.37%, a 5-1-year ARM 2.56%. And then what's neat about this is you can look at the trends over the year, 3 years, 5 years, 10 years, and then it'll also let you know what has changed within the last week or the last year. And I didn't know that about points in terms of how these are reported. And some folks may be looking at these and not thinking about the points or what that means in terms of expenses for them. So just give us the quick definition of points and why it's important that folks understand that as they're trying to compare rates and perhaps get to that apples to apples comparison.
Sure. Points, they're actually called discount points. They're an upfront fee that the lender will charge, and it's often a charge in the form of prepaid interest. And that helps you get a little bit better interest rate. But that is a percentage of the loan amount, so it can be costly. So like if let's say it's 0.3% of a loan amount, if you're borrowing $400,000, well, that's $1,200 in additional fees you're going to pay if you were to obtain that loan. So you do have to be aware of points and fees. That is a big component. And then lenders all have different origination fees. That's another segment of the costs. And those are things that you want to look at too, because not all rates are equal, right? There are a lot of pieces of mail people will get. I'll just leave it at that. There's a lot of mailers you get that'll quote you these really low rates. But then if you read in the fine print, you'll see how much fees are charged. So you really want to be aware of that, because your payback period could be so long, it makes no sense to pay points. And often it doesn't.
So that's number one, know the landscape. Number two, a topic we've talked about before when we've had you on the show, know your budget. And before thinking about pre-approval, it's important to know your budget, as well as knowing how a lender is going to determine what they're going to borrow to you in terms of that home buying purchase. And those things can be, and often perhaps should be, different as you evaluate what fits into your budget and the lender's looking at what they're comfortable in terms of you borrowing. So down payment is not the only cost, but Tony, talk to us about lenders in terms of how they determine how much they can lend to individuals or to couples. And I think here it's worth talking about the 28-36 rule.
Sure. I mean, this step is critical, right? You clearly want to review your own budget and know what you can and can't afford. Because even if a lender can qualify you for a certain payment, that may not be something you're comfortable with, So it's very important to evaluate your own budget. Lenders do look, there is, obviously the 28-36 rule, and this ties into back to what lenders can qualify you for. But often we can qualify people up to a back end ratio, which is a total debt ratio of 45%, sometimes even 50% with enough down payment. So clearly we can often maybe qualify you for more than you want to borrow. The other component to this too, that's very important to know, is that lenders look at your gross income. We don't factor in your after-tax income. So that's another method that we all look at in our industry. We use your gross income that you report on your W-2, or that the gross income before taxation. Same thing if you're self-employed. We look at your gross income prior to income tax. So it's that helps people buy homes and afford homes, but it is a factor to consider when you're running your budget. But historically, those numbers, we do go a little higher. Nowadays, it's instead of 36, which is, and I think, let me just dive into what that means. So the 28% is called the housing ratio. So that's the total amount of your monthly income that is allocated to a home payment, like a mortgage payment on a home. And that mortgage payment includes your principal and interest and your taxes and insurance. So, and any other HOA expenses you might have. So when you buy a home, you have your principal and interest payment on the mortgage. You have property taxes that you typically pay 1/12, so a monthly amount of the total amount of property taxes on a monthly basis. And then your insurance, so your homeowner's insurance. And then some communities have what are called homeowners association fees that might be $100 a month or $100 a quarter, just depends on where you live. And those are all part of the housing expense. So when Tim referenced the 28%, what that means is your total income. So let's say you made, just for round numbers, let's say you made $10,000 gross income as a household per month. We would use $2,800 as your housing expense. I'm not saying that that's what you need to do. You can actually go a little higher, and of course you can go lower. But that's kind of the metric that historically lenders have looked at. And then the back end ratio means your total debts. So that's going to be the aggregate of all your other debts. So your car payments, if you have auto payments on auto loans, student loan payments. So we take your student loan payment, any credit card payments you might have, and any other installment loans you may have. It does not include car insurance, auto insurance, or cell phone bills, things like that, utilities. It does not include those at this juncture. So we don't look at those expenses. But that is going to be the aggregate of all of your debts. And you cannot exceed that. We call it the debt to income ratio. So that's a very critical metric that lenders look at when they're evaluating you for your pre-approval. So that's kind of a high level of what we would look at.
Tony, relevant to our audience, if I zoom out for a moment, we've seen somewhat of a stagnation of pharmacist salaries. Obviously, that's very dependent upon the field and someone's career trajectory. While we've seen a significant bump up in home prices, as well as, I just read an article the other day in the journal about homeowners insurance costs going up. So if we think about what's involved in that 28 to 36 rule, 28% again being maximum monthly housing expenses, 36% would be maximum monthly gross income going to all debts, as you alluded to. And of course, student loan debt, has been going up, as our listeners know too well. So these do have implications, for our audience in terms of understanding these rules, what's involved. And to your comment, just to reinforce it, the number that gets spit out by the lender, may or may not be in line with the budget and the rest of the goals. So we've got to take a step back and determine what makes sense in the bigger picture. Tony, one of the most common questions we get is 20% down, yay or nay? What are the pros and cons of putting 20% down? And I think the reason it's top of mind for many is just the amount of time and savings it can take to put 20% down. So if I'm buying a $400,000 home, I stay true to that, rule of thumb of 20%. Looking at $80,000, I've got $200,000 student loan debt. I've got other competing priorities. That takes time, right, to be able to do that. And so from your perspective, what are some of the things that you think about in terms of the pros and cons of that 20% down payment?
Well, you're exactly right. I mean, it can take a long time to save 20%. And this is a question that comes up a lot. And let's start with the pros. I think let's look at the pros first. I mean, clearly you're going to owe less on your mortgage if you put 20% down. So your payment would be slightly lower, but it's not that much lower because interest rates are so low. So that additional 20% is really not buying you much of a lower payment. It might be, maybe $100 a month or something to that effect, maybe $200 depending on the price of the home, but it's not going to be a substantial amount for the amount you're putting down. So that's one pro. Clear. I'm going back to the pros is you owe less. The other thing is if you're not for example, pharmacists, we have some programs that you can avoid PMI, which we can address later. But if you're not, let's say you're in my role, I don't have a no PMI option for my career path. So 20% down would help us, help a lot of people avoid PMI. So clearly that's a pro. And then, the other thing, you owe less on your mortgage, so you have a little bit more margin there. So, those would be some of the pros. You can also maybe afford more home because your payment's lower, or you're allowed a higher debt to income ratio, because I did reference earlier, we can often even get approvals up to 50%. Well, if you put 20% down, there's going to be no constraints from the MI company or the lender's underwriting, for example. They may allow you to go to a higher level because 20% down frees you up. If you have great credit and you're putting a nice down payment, you can actually get a higher debt to income ratio often, approved. So those would be some of the pros, Tim, of putting 20% down. Some of the cons, clearly one is just how long it takes to save the funds. And that plays into a whole bunch of other things too that I see quite often. I mean, number one, you could use those proceeds to pay off higher interest rate debt, because mortgage rates are low. Plus, the mortgage interest is often tax deductible as well. So you're really not even paying the actual note rate you're paying in many cases. So you could use that extra money to pay off other higher interest rate debt, whether it's auto loans, student loans, or credit cards. The other thing is home repairs, upgrades. If you're looking to remodel, that's very common right now. People will say, hey, I want to redo the flooring in the kitchen, and that gives them greater margin to do that. They'll have their own money. They can actually get into the home, acquire it with less money down, and then of course they can do all those things they want to do to the house, which creates value. One thing just to address with like investment, and this, a home is, more of a lifestyle. It's a place to live. It's an alternative to renting. But if we do work with some savvy investors too, I've referenced it before on this. I'm doing this 20 years. I'm getting kind of old. I have quite a few investor clients, and I've noticed over the years that some of the savvier investors look at their returns differently than a lot of us would, right? They, for example, just think about this. I mean, the average appreciation, let's take out the last few years, it's been way above this, but normally it's like 3.5% to 5% a year, right? Is kind of historical average appreciation for homes over time. And if you were to find a home, let's say you bought a $400,000 home and you put 5% down, so that's going to be a $20,000 down payment. Okay. Well, let's say that house the following year is worth $420,000. Okay. Well, you just made 100% return on your investment. You only put $20,000 down to secure the home, and now your home's worth $420,000. You just made 100% return in 1 year. I mean, it's incredible return, right? Where if you put 20% down, you would have made roughly a 25% return, right? So it's still a good return, but not the same return. And that's how a lot of the investors that are out there look at their returns on real estate. So institutional investors look at it that way, but even us, we can look at it that way, because that's what we invested truly, right? And we put down $20,000 to buy that $400,000 home, and now we've made $20,000 in equity. So we've doubled our investment in that case, versus if we put $80,000 down, which would be 20% down, and we made $20,000 and we got a 25% return. So clearly the con is you don't get the same returns, right? Your return is not as high. And I think I'll add one more thing to that with returns is, you could also use it for other investments. For example, the team at YFP, IRAs, Roth IRAs, there's a lot of other alternatives out there to diversify instead of putting all your money into real estate. I'm a big believer in being diversified. So, I think, clearly a con, if that's a lot of your net worth at 20%, you're putting it all into one asset may not be the wisest thing. So those are just some cons there, Tim, to consider. And I guess as we compare those options.
And Tony, you're alluding to two really important concepts that tie into the financial plan, which is leverage and opportunity cost, right? At any purchase and financial decision we make, there's an opportunity cost or an evaluation of an opportunity cost. Here we're talking about putting more money into a home that might be used elsewhere, right? And I think that for many of our folks, this is a time to do some self-reflection and evaluation as you look at risk tolerance, as you look at other goals that you have, looking at student loan debt, looking at your long-term investment retirement picture. And, that's one of the things I think the team at YFP Planning does so well with the financial planning clients is help them look at a decision like a home purchase decision, have these conversations about appropriate amounts of leverage and the other goals that they're trying to achieve, and then help coach through that decision making while looking at home buying in the context of the rest of the financial plan. And I think this is a good place, Tony, that we just remind folks that down payment, of course, is not the only expense we need to be thinking about, right? We've talked about this on the show before, earnest money, closing costs. So what you're going to need in sum to come at the table to close, but then also beyond just the ongoing monthly payment, which you mentioned, the PITI concept, so principal, interest, taxes, and insurance. What about everything else associated with that home purchase? So whether that's, maintenance and upkeep and things that you expect, remodeling, finishes, landscaping, equipment that you need for the home now that you have that home purchase. So really taking a step back, especially for those that might be currently in a renting situation, to say, hey, what's the total cost and are we ready financially to make this decision? So that's number 2, is knowing the budget. Number 3 is getting pre-approved. So once you've done some research to understand rates, created a budget, save for a down payment, and some of the other costs I just mentioned, next up is getting pre-approved. Tony, why is the pre-approval process so important? What is it, and how is that different from pre-qualification?
Well, the pre-qualification is typically a very easy thing that can be done, but unfortunately it just doesn't carry a lot of weight. So the key differences are an actual pre-approval is going to be when a lender looks at your credit report and then also looks at your income. So it's not just looking at credit, it's actually asking for a pay stub, for example, and we verified your pay stub. Where a pre-qualification, you don't even run credit. You just put in your, what your expenses are and you tell the lender what your income is and they say, okay, great, you're pre-qualified. That doesn't carry a lot of weight in the real estate community. We talk to a lot of realtors. They call us a lot of times on the offers, the listing agents do, when they receive an offer, and the buyer will include our letter, our pre-approval letter. And they ask them, they want to know that the client is qualified because it's a competitive marketplace and they don't want their properties being tied up. So the key difference is the lender has run credit, has reviewed your income. Those are the key differences there between the two. The other thing that the pre-approval, that really brings value that I've seen over the years is the credit report. And I want to bring this up because a lot of us follow our credit scores, whether it's Credit Karma or a lot of these other monitoring services that are out there, but they don't truly give an accurate reading of what a creditor sees. They'll give you kind of a good idea of what your scores are doing. And like if they're moving higher, then the trend is probably good for you. But they can often be 20 to 30 points, 40 points even lower than what a lender sees because we run all 3 bureaus. We don't follow one. So the mortgage community runs a report that has all 3 bureaus, TransUnion, Equifax, and Experian, and we use the median score. So we use the median score of the 3 to determine your credit score. And the value that I think can come here is, clearly your score, which can determine if you qualify, but also your interest rate, right? So the higher your credit score, the better your rates tend to be. And some lenders, and not all lenders can do this, but some lenders have the ability to help you with rescoring. Basically, they have a program where they can tell you what you can do to improve your score. And that's been invaluable for many people that are home shopping right now, that we've been able to get them either qualified or into a better program by telling them, hey, by the way, if you pay down this credit card, for example, your score will go up 20 points. Or if you, consolidate this loan or whatever it might be, you can improve your credit by this much. So that's been something that's been helpful during the pre-approval process, Tim, that I've seen lately.
And that's a good connection back to episode 216, Tony, when you and I talked about common credit blunders to avoid when buying a home. Again, we'll link to that in the show notes. But credit's such an important part of the home buying process for the reasons that you mentioned. So really looking at anything you can do to shore up credit and making sure that you're understanding your credit scores and using the right tools so that you're not surprised when you get into that pre-approval process. So that's number 3, get pre-approved. Number 4 is comparing lenders. So Tony, we know that not all lenders are created equal. Ultimately, we've got to make this decision of what lender am I going to work with? What type of loan am I going to pursue? I think sometimes these are recommendations that might come from an agent, might be recommendations that come from a family or a friend or a coworker, might be a random, internet search. So I think it's worth talking about what are some of the things that folks should look for in a lender. Now, of course, here, Tony, you're representing Iberia Bank First Horizon, and we're going to talk in a moment here about the pharmacist home loan product. So, of course, there's a vested interest in folks evaluating that option. But from your viewpoint, what are some of the things that folks should be looking for when choosing that lender?
Well, there's quite a few different types of lenders out there, and all of them have varying pros and cons to working with. So, I could kind of give you guys an idea of some of the lenders that are out there. You have what are called mortgage brokers, who are true, almost like a middleman between lenders. And there's pros and cons with working with those types of lenders, because they do have a lot of options, where like a larger bank may not have as many options as a mortgage broker. But mortgage brokers tend to be more expensive. And I find that they're typically better when you have a really more tough case, whether it's a credit score issue or some other issue. They can be more valuable than a bank in a lot of ways, because they have some more greater flexibility. Then you have, the correspondent lenders, which are mortgage lenders that may have small branches in a city or a town. They're not a bank, but they are able to lend directly to Fannie and Freddie. They use, not to get too complicated here, but they actually use bank warehouse lines to fund the loans, and then they'll sell the loans, but they're a true correspondent lender. And then, of course, there's banks, but there's different types of banks. There's large banks like the Citigroups and the Bank of Americas and the Wells Fargo. And then there's more of a medium-sized bank like the bank that I work for, and then there's small community banks too. So there's lots of different sizes, and all have pros and cons. There's when you're looking at mortgage lenders, programs are very important. The program that you can get is important. Rates are important as well. The other thing that's very critical is being able to fulfill the timelines, because there is some challenges out there with certain types of lenders where they can't meet the commitment letter deadline in the purchase contract, or they have a struggle with their appraisal process, or they have a struggle closing a loan in 30 days. Those are questions you need to ask the lender up front, because different lenders have different operations. Some will actually use outsourced processing, which might be in another state, whether it's not all under one roof, or the loan originator that you talk to may not have control over that process. So those are just some things to think through. But clearly, there's advantages and disadvantages for every type of lender that's out there. So it's good to know, get some recommendations, and also to kind of compare the products and make sure it's a fit for you and that you feel comfortable with the group that you're working with. I think ultimately that's the most important thing, that you feel confident that they can help you and fulfill the closing date for you. That's a key element.
Yeah, and it's a good reminder, Tony. Interest rates, of course, are very important for the reason we mentioned, in terms of the length of the loan and what that's going to mean in terms of dollars out of pocket. But don't overlook, some of those things about abilities around appraisal and underwriting and closing on time and communication, and making sure that you feel comfortable. And there's, of course, going to be some open communication. There's a lot of things that need to get done in a short amount of time. So I think this is a good place to highlight the pharmacist home loan product that is offered, Tony, through your organization, Iberia Bank /First Horizon. We're seeing a lot of interest in the pharmacist community about this product, which, many listening might have heard of doctor type of loans and think, hey, I'm a pharmacist, I'm not eligible for that. And here with Iberia Bank /First Horizon, we have an opportunity that is available to pharmacists. So talk to us more about that program in terms of down payment, what's involved or not with PMI, maximum loan amounts, and where this option is available in terms of where folks may live.
Sure. Well, and this product is often a great solution, and it's been really fun to be able to help so many people with this program. It is somewhat unique in that you can put very little down payment and not have PMI and still have very aggressive interest rates too. So to kind of just highlight the program overall is, if you're a first-time home buyer, first time buying, you can put as little as 3% down. And of course, there's no PMI. If you've owned a home before, it's 5% down. You'd have to put a 5% down payment. And the no mortgage insurance clearly is an advantage. But the other thing too is, oftentimes the rates on this program, the 30-year rate that we offer on it, is often better than my 20% down rate. So you're still getting a really competitive, rate, and priced very, very well. As far as the minimum credit score is 700. So there is a minimum credit score. You have to be above 700. There's no clear reserve requirement. What that means is having extra money, reserves of payments in your bank account or investments, which is nice too for a lot of first-time home buyers and those that are buying their first home. But the other piece about the loan limits that Tim referenced, currently our loan limit is on this product is $548,250. But that's about to change. I think we're probably looking at least $625,000 in January, starting January 1st, 2022. So we're going to see a nice bump up. It may even be higher than that, and that'll be across the country. So this program is available in basically the 48 lower states. Alaska and Hawaii are the only two states that we're not licensed in, but we can offer it in 48 states. So it's a nice footprint that we can help. And we've helped individuals in pretty much every state, I think, so that I referenced it. But the loan limit thing is exciting because I think that's going to enable a lot more people to buy in higher priced areas. And we may even see that go higher than that in certain areas that are even higher priced. There's a certain parts of the country that priced markets, housing prices are much higher, clearly in California, in and around DC, Northern Virginia. So those are some places where this could be even higher than 625. So yeah, it's exciting that we're see a little bit of a move higher there.
So sorry to our friends of YFP in Alaska, Hawaii, as Tony mentioned, this is available in the lower 48. We've got more information that goes into more detail on what Tony just shared there. You can find that at yourfinancialpharmacist.com/home-loan. And again, that's a summary of much of what we're talking about here on this episode as well. So Tony, we've talked so far about knowing the landscape of interest rates. We referenced the Freddie Mac resource. Folks can go to find that information, making sure that they're considering that points may be included in those rates as they're looking at various options. So that was number one, know the landscape. Number two, we talked about knowing your budget, the importance of not only the down payment, but also other costs that are involved in the transaction, as well as ongoing costs with the home purchase. Number three, we talked about pre-approval, why that's so important, how it's different than pre-qualification, and how the credit score has implications there. Number four, we just talked about comparing some of the lenders and the options that are out there. And we talked about the pharmacist home loan product. So here we are finally. We've put in an offer on that home. We've got our lender obviously lined up. We're working with that agent. Hopefully that offer is accepted. And now we've got this process that happens from offer accepted to ultimately closing on the home where those keys are handed over. So what should folks expect in this application underwriting process in terms of forms that they're going to need to prepare, documents that they're going to have to show, and any work that they might be able to do in advance to get some of that ready?
Yeah, so the exciting part happens, right? We've got the property under contract, but there is quite a bit of items that lenders will need. And once you feel comfortable and you found the lender that's a good fit for you, lenders were all really going to need the same things, and it's going to be income information, right? So if you're self-employed, we'll need typically 2 years of your tax returns, both your corporate returns and your personal returns. And then for income for those that are employed, it's a little easier. You just need 2 years of your W-2s and your most recent pay stubs for the past 30 days. Those are what lenders will need to verify income. Then we're going to have to verify your down payment. And typically that's going to be bank statements. And lenders have different types of ways to do this. We actually have a technology that it's not our proprietary technology. We have a fintech company out of California that has been doing very well in the mortgage space. They built a platform where when clients enter their information, we can actually do a read-only format for your bank statements. So you don't even have to supply them. It'll tell us what's in the account in the average of 2 months, and we verified it that way. So that's been really helpful, and a lot of clients have liked that. But outside of that alternative, traditionally it's 2 months of statements. So 2 months of your most recent bank account statements to verify the down payment. If they need additional reserves, if the lender needs additional reserves, and if you have a IRA or 401k or any investment account, brokerage account, those assets would be verified with 2 months of statements or a quarterly statement as well. And then, of course, we'll need a copy of the purchase contract. So typically, once you have a purchase contract available, you're able to lock a rate in. And that's important because rates can be volatile. They can move. And, especially with economic reports, that can cause rates to move up and down. And lenders typically cannot lock rates until they have a purchase contract, so they know how long to lock it and they have an actual property address for the bond that they're locking, basically. So that's another step that we'll need. The other items that you need to work on too is homeowners insurance. I always encourage people to get started with that as soon as possible, especially if you're in the southern states, southeastern states during early July through the end of October. We have some tropical storms down in this area and hurricanes. Even if they're not any threat to you, if they are in what's called the box, insurance companies have limits on when they can write insurance. So we're always very encouraging to get that process started soon. So homeowners insurance is an important component. And, typically driver's license, things like that. The application will go through all the questions about your employment, where you've worked the last couple of years, a lot of your vitals, date of birth, social security number, those types of things. Then you're on your way, So it's an exciting, that's when the process officially begins. And, typically the appraisal is ordered shortly after that mortgage application is put in. So we also need to know who your realtors are, if there are realtors involved, so they can open the home. They can be the point of contact for the appraiser. That's another item that we need to know. We need to know the parties who are involved. And often we do, but I just include that because that's something else the lender will need to know. You may need to supply that to your lender. Make sure that you do that information, the key contacts in the transaction. But from that point on, the journey's on and you're moving through the loan process after you make that formal loan application.
Yeah, and I mentioned a few moments ago, Tony, the importance of open communication. This is an exciting time. This can feel overwhelming. There's a lot of moving pieces and parts. And I think much of what you just shared to me is a good reminder of folks of this is the time to over communicate, right? On both sides, for both the lender as well as the home buyer, and making sure that you're being responsive. Things need to move quick. There's a lot of ducks that need to get in a row. And the other reason I think this section here on our final one on completing the application and bringing this whole process to ultimately a close is folks should be thinking about some of the information that's being requested and what implications things like job transitions may have, big financial purchases people are making, right? Ideally, we're trying to have as little disruption as possible in this time period because of the information that the bank is requesting from you and wanting to have the stability of both that funds to close as well as looking at your income. So for folks that are in transition, for folks that have pending large purchases, I'm thinking of the residents and the fellows and those that are moving from a first to a second job, just be thinking about some of the timeline and the implications that has on finishing up this process and ultimately the overall home buying process. Tony, great stuff as always. It's been a great year of having you on the show and always appreciate your input and your expertise. And folks, again, more information, yourfinancialpharmacist.com/home-loan. You can learn more about all of what we talked about here on this episode, as well as the Pharmacist home loan product, and get in touch with Tony and the team at Iberia Bank First Horizon from there. Tony, thanks so much.
Thanks for having me, Tim. Always good to be here. Thank you again.
Before we wrap up the show, I want to again thank this week's sponsor of the Your Financial Pharmacist podcast, Iberia Bank /First Horizon. We're glad to have found a solution for pharmacists that are unable to save 20% for a down payment on a home. A lot of pharmacists in the YFP community have taken advantage of Iberia Bank /First Horizon's Pharmacist Home Loan, which requires a 3% down payment for a single family home or townhome and has no PMI on a 30-year fixed rate mortgage. To learn more about the requirements for Iberia Bank /First Horizon's Pharmacist Home Loan and to get started with the pre-approval process, visit yourfinancialpharmacist.com/home loan. Again, that's yourfinancialpharmacist.com/home loan. As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer.